The entire US banking system just cracked, and this time it might not be contained. Regional banks fell as much as 10% in a single session. The S&P 500 banking sector dropped over 3% the same day. And you know what's not suspicious at all? Insiders were selling before the headline hit. Institutions dumped roughly $3 billion in US equities last week, and hedge funds have averaged more than $2 billion in net selling per week for 4 straight weeks. This is the biggest 4-week selling streak since 2008. Meanwhile, retail kept buying the dip, chasing AI everything and quantum computing names worth billions with zero revenue, and offices that look like this. Draw your own conclusion. So if you're asking why you should even care, here is why. If your money is the water, the banks are the pipelines that make the whole system run. When the pipes crack, everything slows or stops: stocks, paychecks, and credit. In the next few minutes, I'll show you exactly what's happening with the banking crisis, how insiders moved first, and a simple plan to protect your account before it gets even worse. And if you think your AI, your crypto, or your 401k is immune, think again. At this point, you might be saying that's a bold claim from just a random internet guy. Fair enough, but analyzing risk has been my job for over a decade. If you're new here, welcome. I'm the trading actuary. That actuary part means I measure risk for a living. Well, I used to do it for Fortune 100 companies, helping them forecast billions of dollars. Now, I run my own consulting firm specializing in AI and risk management. And I use that same mindset in the markets, which I've been trading even longer than I've been an actuary. The goal with this channel is very simple: share my knowledge with people who care about finances, the economy, and the markets, and also have constructive discussions about these things. I also run a free newsletter with trade ideas, chart setups, and much more. If you want to join hundreds of traders and market enthusiasts already using it, the link is in the description below. Now let's get into this. When the smaller and mid-sized banks, your local lenders, drop more than 10% in a single session, it should make you question how strong the system really is. We were still within 2% of all-time highs in the indices, while the fear and greed gauge flipped to extreme fear. And no, this wasn't a single headline. It was a cluster of bad loan and fraud disclosures, plus a couple of bankruptcies hitting at the same time. One bank disclosed a fraud-linked charge-off, and another faced borrower default where the collateral didn't cover the loss. That's the cockroach rule. If you see one, that means there are more in hiding. Selling spread from one name to the next. Before you knew it, regional banks were down almost 10%, and it pulled the whole market with them. We did get some recovery later, but a bounce doesn't fix broken pipes, it just buys time. Traders are in show-me mode right now. Until we see clean proof that borrowers are paying on time and losses aren't spreading, every pop gets faded. So why did a couple of bad loans rattle everyone? Because it's not just about one loan, it's about the plumbing. Regional banks run lean. They rely on daily deposits, quick government payments, and short-term funding to get through each week. With the government shut down, those payments slow down, contractors and refunds get delayed, and loan programs pause. Deposits thin out and cash flow slows. And when deposits fall, smaller banks have to sell assets fast. Forced sellers don't get good prices, and losses create fear. Fear creates more selling, and that's how you get a loop. And there's another loop most don't see. A lot of lending happens outside of the banks. That's the private credit. Non-bank lenders make the loans, but the bank still gives them credit lines. If one of those loans goes bad, the loss can come back to the bank that provided the line. Now add private equity, which is big money groups that buy companies. Banks lend to those groups and the companies they buy. If one of those companies gets in trouble, the group needs cash and asks the bank for more. And that's how the bank can take a hit even when it wasn't the bank's own loan. If those off-book loans go bad, funds raise cash the only place they can, by dumping the big liquid names. And if you watch my last video, you know where the market is concentrated the most. Those are usually the first to get their fat trimmed. And here's your hint. It's the Mag 7, which drives 35% of the entire index. And that's how a small problem becomes everyone's problem. That's how this hits your portfolio, whether you're in AI, crypto, or looking out for your 401k. And then there is the commercial real estate, still grinding away in the background. Offices sit half empty in a lot of cities. Landlords keep asking for more time. Banks agree and extend and pretend, delay the loan, tweak terms, hope it improves. In your opinion, if companies start forcing the employees to show up at the office, how many do you think will quit and go to a competitor who still offers remote work? We have created a beast that can't be stopped. The genie isn't going back in the bottle. To me, this is a ticking time bomb. And a few videos back, I shared that data centers are now overtaking general office construction. The money, power, and land are moving to servers, not cubicles. It's really great for chips and utilities, but not so much for the banks still holding office loans from that last cycle. Now add interest rates. The Fed cut rates in September and might cut again soon. As of recording this video, rate cut odds for October are about 94%. Lower rates can help because borrowing gets cheaper and many bonds go up, but they can also hurt if banks lowers loan rates faster than the interest they pay on deposits. That squeezes bank profits. Whether a cut helps or hurts depends on each bank's mix of assets and liabilities. The bigger worry is that the rate cuts often arrive with slower growth, which raises credit risk when lenders are already nervous. And hiring demand is also rolling over. Online job postings keep slipping, especially white collar. Less hiring means less spending, and that weakens credit quality. Banks really hate this setup. Now let's talk about the elephant in the room. Before the headlines hit, big funds were already selling for weeks. A few days before the bank news, huge options bets showed up that stocks might drop. It's like cockroaches. See one and you know more are hiding. Pros cut risk while the crowd chased green candles. That's how retail ends up as the exit liquidity, buying what they're dumping. And I've been saying this for months on this channel and in my free newsletter. I've been breaking down flows from institutions, hedge funds, and retail. The data showed smart money is exiting or hedging while retail was chasing. I tried to raise the flag and I hope some of you hedged before this hit. I did. I laid out my hedges in the newsletter about 3 to 4 weeks ago. And it wasn't just me and the institutions hedging our positions. Executives were cashing out too. Even the AI king was cashing chips. Nvidia CEO Jensen Huang sold over $250 million of Nvidia in the last 3 weeks. I actually called out one of the $42 million sales in my last video, but I didn't cash the rest before that. Add the $800 million he dumped a few months ago, and he's already cashed out over $1 billion this year. Meanwhile, retail keeps chanting Nvidia to the moon. And retail's new obsession, quantum computing. The one everyone is pumping right now is Rigetti Computing, or RGTI. And here's the kicker. The CEO sold all his shares back in May. Nice company you've got there. Even the own CEO won't hold the stock. So what now? We're heading into homestretch. People love to say Q4 is usually strong. Maybe, but this setup is different. We've got cracks in regional banks, tight money pipes, record credit debt, and a market that's more leveraged and more concentrated than the dot-com days. Wallets are already stretched. About $1.3 trillion debt on credit cards, roughly $11,000 per household. And most of the active managers aren't doing well either. Only 22% beat the market this year, worst in decades after staying light on most crowded tech. If leadership slips, there isn't much cushion. Those pictures don't match. Stick until the end and I'll tell you exactly what my game plan is going into year-end and into next year. At this point in the video, I usually cover economy calendar and earnings report, but I noticed most of you skipped that part, so going forward, I'll be covering it in my free newsletter. The link is below. Now, let's wrap this up and talk about what I'm doing and what you need to keep your eyes on. The pipes cracked and confidence snapped, so I kept it very simple. I trimmed some of my overcrowded names last week and trimmed a bit more this week. I'm not abandoning them. I plan to re-enter when prices come down. Roughly 20 to 40% lower is my zone. And yes, uranium is on my list to buy back later. I added 2 hedges I opened a month ago and kept them small. I also bought some VIX calls on Friday when it dropped. The position is very small, and the idea behind this is if we see something seriously break in the system, VIX will pop. So I want to have some exposure, even if it's small. My main protection is still index puts and put spreads. They are very liquid, easy to manage, and they're usually cheaper than trying to hedge every single stock in my portfolio. For everyone asking what do I do, trim anything that's gotten too big so one headline can't nuke your account. If single stock options are pricey, Hedge with simple index put spreads and give them some time. Keep some cash so you can actually buy dips instead of just watching them. Decide now where you'll buy back your favorite names and scale in slowly, not all at once. Stick with companies that make real cash and carry less debt. When the hedge does its job, book it or roll it smaller. Don't let it decay back to zero. As to what I'm watching right now, it's the stress in regional banks, movements in the VIX, and whether the crowded leader starts slipping. I'll keep you posted on what I see in the newsletter, so make sure you sign up. It's completely free. I also provide technical levels, chart setups, and trade ideas on my link. The link is below. If you got any value from this video, please click like and subscribe. And let me know in the comments below. Do you think we're about to see a market correction? And did the regional banking crisis just kick it off? And if so, what are you doing to stay protected? If you want more detailed breakdown of market concentration, and more specifically the AI bubble behind the scenes, then check out my last video. I go deep into it and also cover strategies you can use to hedge and be protected. Thanks for watching, and I will see you in the next one.